Have you ever wondered how companies like TCS, Reliance, or Infosys make billions by just selling shares? Or how regular people invest a few thousand rupees and earn profits without even running a business? That's the magic and the logic behind the stock market. But don't worry, this video isn't about complicated finance terms or confusing charts. In the next 15 minutes, we'll break down how the stock market actually works, how companies raise money from it, and how investors like you and me can earn from it. Let's make the world of finance simple, practical, and crystal clear. Money bag. Section 1. What is a stock market? Let's start from the basics. A stock market is a place where companies and investors meet, like a marketplace. Instead of buying fruits or clothes, people buy and sell shares of companies. A share represents a tiny ownership in a company. If a company has 100,000 shares and you own 100, you literally own a small part of that company. In India, the main stock exchanges are BSE Bombay Stock Exchange, NSE National Stock Exchange. These are the platforms where all the buying and selling happens, digitally every second. Section 2. Why companies sell shares. Now, why do companies sell shares in the first place? Simple, to raise money. Let's say you start a business and it's growing fast, but you need rupee 10 crore to expand. Instead of taking a big loan, you can sell shares of your company to the public. This process is called an IPO, initial public offering. People invest their money, you get funds to grow your business. And in return they get ownership, a small piece of your success. So companies use the stock market to raise capital, and investors use it to grow their wealth. It's a win-win system when managed wisely. Section 3. How investors earn money. Now the big question, how do investors earn? There are mainly two ways. 1. Capital appreciation. When a company performs well, its share price increases. If you bought one share at rupee 100 and it becomes rupee 150, you earn 50 profit. 2. Dividends. Companies sometimes share a part of their profits with shareholders, called dividends. So the better the company grows, the more valuable your investment becomes. But remember, just like profits, losses can also happen if you invest blindly. That's why research and patience are key. Bar chart. Section 4. The role of the market. The stock market isn't just about buying and selling, it's the heartbeat of the economy. It helps companies grow by raising funds. Investors earn by owning a part of those companies. The country's economy expands through innovation and jobs. When markets do well, businesses thrive, employment rises, and confidence grows. When markets fall, it reflects fear, uncertainty, or slowdown. It's like a mirror showing the mood of the economy. So to sum up, light bulb, the stock market is not gambling, it's ownership. Light bulb shares are pieces of companies you believe in. Light bulb companies raise money through IPOs. Light bulb investors earn through price growth and dividends. It's not about quick money, it's about long-term growth, trust, and understanding how businesses work. If you start early, invest wisely, and stay consistent, the stock market can be one of your strongest wealth-building tools. So next time you hear Sensex went up or Nifty went down, you'll know exactly what it means and how it affects you. If you found this helpful, make sure to like, share, and subscribe. And keep following my 100 Days of Learning series, where we decode topics from economy, technology, science, and the world around us, in simple and practical language. Thanks for watching, and remember, learning is your best investment. Chart increasing with yen.